So how do tax treaties impact the overall tax pictures for individuals moving between Canada and treaty countries?
Yeah, so treaties can have a big impact on the overall tax landscape. How important they are depends a bit on the specific facts and kind of the asset mix. But often they come up in a couple of different ways. One is with Canadian withholding rates. That comes up regularly. So if you have somebody who is departing Canada, but they're continuing to earn Canadian source income, they would be subject to Canadian withholding. And our default rate is 25%, but most of our treaties reduce that quite a bit. So, for example, somebody leaves Canada and they have an interest in a Canadian company and they receive dividends through that company. Instead of the 25% default rate, it might be 15% or even 5%. And that can have a significant impact, especially where the dividend income is maybe a major source of income for that individual going forward. And the other way that tax treaties can really have a big impact is kind of dealing with the issues around double taxation. Because if you're a resident of Canada and you're also subject to tax in another jurisdiction, for example, as a citizen of the US, which is the scenario that comes up a lot here, you're subject to tax in both countries. And you can be taxed on the same asset and the same income stream.